Hello friends, welcome to KT Research Guidance Bureau. Myself, Dr. Kumudini R. Thakur, would like to say few words for the Bureau. This Bureau is very helpful to research students, undergraduate and postgraduate students. Moreover, those who are interested to clear NET, SLAT or any other competitive exams, this bureau will give complete guideline for various subjects. So my humble request to you that please subscribe the channel, give your comments and favor for the bureau. Today's session is specially for break-even analysis. In first and second session, we learn theoretical background and basics of break-even analysis. Second session was specially for multiple choice questions, and this session will give you the idea about various aspects of break-even analysis with problem and solution. Please keep in mind, if you want to learn accountancy, then you have to do practice for that. So my humble request to you that please take a notebook, ball pen, calculator, and not only your physical presence but mental presence also. And when I give you the sum, that time write down and side by side do the calculations also, so that you can understand calculation and can verify your answer whether it is right or wrong. So let's begin with first sum. Following information is obtained from Astha Company Limited. 2 years data, year 19 and 20. In that one, number of unit cells 10,000 and 15,000 respectively. So far as result is concerned, in first year when your cells was 10,000, that time company suffered a loss of rupees 10,000. And next year when cells was 15,000 units, that time company enjoyed 40,000 rupees profit. From this information, you have to calculate mainly two things. First, fixed cost, and second one is break-even cells in units. First of all, you have to remember the formula for that. Moreover, which formula you can apply to find out the required question. First is fixed cost. If you want to find out fixed cost in these types of data, then first of all you have to find out PV ratio. And with the help of PV ratio, you can find out cells. 2 years particulars are given. In that one, first year sales was 10,000 and next year 15,000. So sales increased by 5,000 rupees. So far as result is concerned, first year there is a loss of 10,000 and next year company enjoyed a profit of 40,000. So obviously you feel that you have to write down 40,000. No. How to calculate? Let's try to understand. So PV ratio is equal to change in profit by change in sales into 100. As I told you that first year there was a loss and next year company enjoyed a profit of 40,000. So actually change in profit is not 40,000 rupees, it is 50,000 rupees because last year there was a loss and that loss company recovered. So change in profit will come 50,000 rupees and change in sales, it is easy to find out. 15,000 minus 10,000 is equal to 5,000. So 50,000 by 5,000 is equal to 10. That is your per unit contribution. So first information you find out. Now per unit contribution is 10 rupees. So obviously you can find out total contribution for 2020. So total contribution is equal to 10 into 15,000. So your contribution comes 1,50,000. What you have to find out? Sales. So for that calculation, you must have some tricks in your mind. Contribution you find out. So obviously what is given? Profit is given 40,000. So with that help you can find out what you can find out? Fixed cost. So profit for 2020 is 40,000 and contribution you find out 1,50,000 minus fixed cost. So your fixed cost is equal to 1,10,000 because profit is equal to contribution minus fixed cost, or remember this way, S minus V equal to C minus F equal to P. This shortcut method you have to mark up. So fixed cost is 1,10,000. With this figure, easily you can find out break-even point. So break-even point is equal to F by C equal to fixed cost by contribution. Both figures are available. 1,10,000 by 10 is equal to 11,000 units. So in this example, 2 years data were available and with the help of that data we find out missing information, or you can say hidden information, and on that base we can find out break-even point. I hope you followed the example very nicely because this example is little bit easy. Now let's move towards second example. Ganesh Company Limited gives you the following information for the year 2020. Break-even point sales, rupees 80,000. Fixed cost rupees 32,000. Earned profit equal to rupees 68,000. From these particulars, you have to find out so many things. Among them, first is profit volume ratio. Second is sales of year 2020. Third is if the sales increased by 20%, then what will be the profit? In fourth one, if present selling price is reduced by 20%, then you have to find out three items: new profit volume ratio, break-even point sales, and sales to earn 100% more profit than achieved in last year. And if the selling price is increased by 20% and yet there is a loss of 10,000, then sales amount you have to find out. You feel that example is very lengthy, but when the example is lengthy, that time it is easy to find out. So what is given? Break-even point sales is given in rupees, fixed cost is given, and earned profit is given. Obviously, easily you can find out PV ratio. So, and second is sales. So at the same time also you can find out both things. First of all, let's try to understand break-even point in rupees. You know the formula. BEP is equal to fixed cost by PV ratio into 100. Fixed cost is already given. Moreover, break-even point sales is also given. So with these two figures, easily you can find out PV ratio. 80,000 is your break-even point sales. So 80,000 is equal to 32,000 is fixed cost by PV ratio into 100. So you find out first item, that is 40%. 40% is your PV ratio. If PV ratio is available, then you can find out so many things. Among them, see, your sales earned profit is already given 68,000, and your profit volume ratio is given and fixed cost is also given. So with that data you can find out, plus fixed cost 32,000. So the total comes 1 lakh rupee. Your ratio is 40%. So 40% equal to 100. Then how much for 1 lakh rupee? So how much it will come? 2,50,000 equal to your sales. This is answer for your second question. So you have to find out sales. How you can find out? Profit plus fixed cost. See, as I said you in the first question, what you have to mug up? S minus V equal to C minus P. F is equal to P. So in this case, if you add fixed cost, then you can find out 1 lakh rupee. So sales 40 equal to 100. Then for 1 lakh, PV ratio is 40%. So for 1 lakh it is how much? So your sales come 2,50,000. Third question is about sales is increased by 20%. If your sales increases by 20%, sales you found out 2,50,000. 20% of 2,50,000 is equal to 50,000. So obviously, easily you can find out new sales. New sales equal to 2,50,000 plus 20% equal to 50,000. So 2,50,000 plus 50,000 is equal to 3 lakhs. Now, your sales is 3 lakhs and your PV ratio is 40%. So 40% of 3 lakhs is equal to 1 lakh 20,000 minus fixed cost. Fixed cost is already given, that is 32,000. So rupees 88,000. This is the answer for your third question. So if sales increased by 20%, then your profit will be 88,000. Now one question may come to your mind, that why we have to do various types of alternative. Because break-even analysis is very useful for decision making, and top authority always tries to find out if there is a change in one variable, then what will be the effect of that change on another variable. So there is a change in one variable, sales. So what is the effect on profit? That is 88,000. Previously your profit was 68,000. So if you increase your sales, then obviously your profit will also increase. So with the relation of one variable, try to understand the impact of that variable on another one. Fourth one is, if present selling price is reduced by 20%, then three things you have to find out. Among them, first one is new profit volume ratio. Obviously, you are reducing the price. So 100 minus 20 is equal to 80. So 80 equal to 20. Then how much for 100? It will come 25%. That is new profit volume ratio. Easy to find out. 100 minus 20 equal to 80. 80 equal to 20. Then how much for 100? That is 25%. Now B, new break-even point sales. You know the formula for that. BEP is equal to fixed cost by PV ratio into 100. Fixed cost you know, that is 32,000, and your PV ratio you found out, that is 25 into 100 is equal to 1,28,000. So if you reduced 20%, then your new PV ratio will be 25% and your new break-even point is 1,28,000. So see the impact of one item on another. Now see question in that one. Sells to earn 100% more profit. What you want to do? You want to increase your profit by 100%. How to find out? Previous profit was 68,000. 100% means multiply by 2. So your new profit will come 1,36,000. Now it is easy to find out. F plus P by PV ratio means fixed cost plus profit by PV ratio into 100. Your fixed cost is 32,000. Your new profit is 1,36,000 by 25 into 100. So your sales will be 6,72,000. So if you want to increase the profit, then obviously you have to increase your sales. So in modern theory, what they do? First, they fix the target of profit. How much profit you want to enjoy. And on that basis, they will try to sell their commodities in the market. And many times for that, they may enter in foreign market, and that time they can adopt dumping policy and all this so that they can enjoy more profit, and China is one of the best example for that one. So for fourth question we calculated all these three things. New profit volume ratio tends 25%. New BEP is rupees 1,28,000, and to enjoy double profit your sales must be 6,72,000. Now the fifth one is, if the selling price is increased by 20% and yet there is a loss of rupees 10,000. So what happened? You want to increase the price by 20% even though there is a loss of 10,000. Then find out the sales. How to find out it? Okay, let's try to understand. 100 plus 20 you want to increase is equal to 120. Now your profit volume ratio was 40%. So obviously rest of the percentage means 60% that you have to deduct. So 120 minus 60 is equal to 60. Then 120 equal to 60. Then how much for 100? That is 50%. And in exam you have always short of time. So in one step you can solve, or directly you can write the formula and you can solve the sum. But We are learning it. That's why I show you the simple calculations also. And obviously 120 minus 60 is equal to 60. Then it is 50%. Anybody can understand. So sales is equal to 32,000. That is your fixed cost plus profit. Now plus profit, but there is a loss, means minus 10,000 by 50 equal to 4 lakh 40,000. So if you increase the selling price, even though you have a loss, then your sales must be 4 lakh 40,000. How you can find out? 100 plus 20 is equal to 120 minus 60. Why? Because your PV ratio is 40%. So that is 60% is equal to 60. So obviously your new PV ratio is 50% and sales is equal to F plus P by PV ratio. F 32,000 plus minus 10,000 by 50 is equal to 4 lakh 40,000. That is your sales. I hope you followed it very nicely. Now let's try to understand with another example. The following information are in respect of Hethel Limited. Margin of safety 25%. Profit volume ratio 40%. Fixed cost rupees 30,000. On this data, you have to calculate first break-even sales, second actual sales for the year, profit for the year, fourth one is variable cost for the year, next required sales to earn profit after tax 30,000 and tax rate is 50%. And last one is if selling price is reduced by 10%, then find out new break-even sales. Safety margin is 25%. PV ratio is 40%. Fixed cost is 30%. So easily you can find out break-even sales. It is easy. BEP is equal to F by P into 100. F is given 30,000 by 40% into 100 is equal to rupees 75,000. So your first answer is rupees 75,000. Next one is actual sales for the year. Let's find out. How we can find out? Margin of safety is given and BEP sales you find out. So sales is equal to BEP sales plus margin of safety sales. BEP sales 75,000 plus 25%. Margin of safety is 25%. So obviously it is 25,000. So your sales is rupees 1 lakh. It is easy to understand. Only you have the idea about sales is equal to BEP sales plus safety margin. Then you can calculate sales very easily. Third one is profit for the year. Let's try to understand profit for the year. Now sales is given. Variable cost you know. And fixed cost also you know. So it orally also you can find out. Variable cost sales minus variable cost minus fixed cost. Sales is 1 lakh, variable cost is 60,000 because your PV ratio is 40%. So cost is 60%. So 60% of 1 lakh is equal to 60,000 and your fixed cost is already given, that is 30,000. So profit is equal to sales minus variable cost minus fixed cost. 1 lakh minus 60,000 minus 30,000. So your answer is 10,000. It is easy to understand, so you can understand very easily. Now the variable cost for the year, no need to do any calculation because in third you already find out it is 60,000. So directly you can write down your variable cost is 60,000 rupees. No need to do calculation or anything because already step by step you find out everything. So it is 60,000 rupees. In fifth one, required sales to earn profit after tax 30,000. Now keep in mind, fixed cost is given and P is after tax 30,000. So obviously before tax it is double than that one, 60,000, because 50% is the tax rate. So how we can find out? Fixed cost plus required profit by PV ratio into 100. Fixed cost 30,000 plus required profit, not 30,000 because that is after tax profit. So we have to find out before tax, plus 60,000 by 40 into 100. So your answer is 2,25,000. And last one is, if selling price is reduced by 10%, then find out new break-even sales. What you want to do? You want to reduce selling price by 10%. Same logic you have to apply. Which one? 100 minus 10 is equal to 90. And your ratio means if you will reduce the selling price, it doesn't mean that your cost is also reducing. It is 60%. So 60% of 100, not 90. So 60 is equal to 30. 90 equal to 30. Then how much for 100? 33.33 percentage. This is your new PV ratio. So generally students are doing major mistake for this cost. 40% means 40 of not 90. You are reducing selling price but your cost is same. So 90 minus 60 is equal to 30. So 90 equal to 30. Then how much for 100? 33.33 percentage. That is your new PV ratio. Now it is easy to understand. So BEP is equal to 30,000 by 33.33 percentage into 100. So your answer is rupees 90,000. So if you reduce the selling price by 10%, then your new break-even sales will be rupees 90,000. These are the sums with clear understanding. I hope you enjoyed the session. And next session again for problems and solutions of break-even analysis. So for that, again, try to solve these sums by yourself so that next session clearly and quickly you can understand and calculate. My humble request to you that please subscribe the channel, give your comments and favor for the bureau. Thank you very much. So nice of you.